and we can proceed and start with the panel.
All right, thank you. My name is Jason Lau. I'm Chief Innovation Officer at OKX. At OKX, we're a crypto platform. Our mission is to provide access to crypto, and specifically crypto markets. We do that via our exchange, where we service over 120 million users, institutional and retail users, across, like I said, the exchange, which is a centralized exchange product. We have our wallet, which is a self-custodial product. We have XLayer, which I'm excited to be here to talk a little bit about. That's our layer 2. As well as new things like our agentic wallet that we just launched last week. So yeah, broadly, we're here to make sure users of all kinds have access to crypto easily.
Hey guys, I'm Reid Simon. I head digital assets for Figure. Figure started in 2018. We're probably most well known for HELOCs. We've tokenized natively about 23 billion. We do about $1 billion a month of new loans. But I think what separates us from some of the other players in RWA is we really are a full stack. So we actually are the originator. We have the infrastructure for tokenization and trading. We have securitization vehicles. It's really a turnkey solution for asset issuance, trading, and distribution through DeFi.
Great, and good to be on the panel. So John Hallahan from Fireblocks, lead our business solutions team. So for those not familiar with Fireblocks, we're probably the largest provider of infrastructure and digital assets. So over 3,000 institutional customers, processing in the region of $6 trillion on a yearly basis. So relatively significant. If you're not familiar, the crypto that you might buy on Revolut is basically built on Fireblocks infrastructure the same way if you're a large institution. If you're accessing crypto at BNY Mellon, that's the same infrastructure. So at a very basic level, we enable companies to custody assets, issue them, and then also transfer them.
Great. So one continuous sentence that, I started in the space as a Bitcoin maxi and then Ethereum and all over the place. And, the sentence that is recurring is not your keys, not your money, right? But the institutions that are entering the space are always relying on parties like, for example, Fireblocks, or parties that can help them to kind of, manage and trade and treat these digital assets. And so TradFi and DeFi is always, a kind of it's many years that we hear institutions are entering DeFi, but then it's probably this year. So my question for you is, the institutional DeFi is a paradox in the sense that institutions will never self-custody their assets, or is how do you see this space evolving on the management of the keys for such institutions? You can start, Jason.
Sure. So as I mentioned, we service all types of users across the spectrum, from people that want to self-custody and those that don't, right? And we think that we think self-custody is very important, right? But the most important thing is having the choice to do so when you want to. And so institutions in particular are obviously very particular about how they manage their assets. They, as you alluded to, they have compliance obligations, they have regulatory compliance, regulatory obligations, they have risk committees, they have a whole slew of processes that need to work for them. And even for institutions, that's not one size fits all, right? There are smaller institutions where, yeah, of course, they're probably already using Fireblocks, they're already custodying assets with us, they're maybe using a self-custodial wallet themselves and dabbling with DeFi. So I think there's no one size fits all, number one. And then number two, for us, we're building products that hit and help each of those segments perform what they need to. If you're highly regulated, that as you're implying, which is the institutions that have yet to come into DeFi, I'd argue that they're doing things where they're working with trusted counterparties, regulated counterparties like us, where they may put assets on our platform and then access DeFi via our platform. So I think there's different ways to get to the end goal while preserving the choice that's so important for us here.
Yeah, so I think maybe the better question is, are institutions going to avail themselves of composability? Because there's a little bit of a friction point there, right? Which is, can your custodian make something composable or use it in DeFi. Maybe they'll custody your LP token, or they'll use extensions from Fireblocks to perform some of those activities. But I think we've taken the approach of you have to serve all of your customers how they want to be served. So that can look like more of a Web 2 experience. It looks like that, but it's really an MPC wallet on the background. It can be an integration with Fireblocks where they want to hold an asset. But also there are institutions and public companies in regulated spaces who are using self-custody. And they are doing this themselves on plenty of the platforms in DeFi. So I don't think that there's one answer or one solution. I think it's you have to serve your customers how they want to be served.
Yeah, and maybe to maybe like push back on the framing a little bit from our perspective. So we're not a custodian, we're a self-custody platform. So our 3,000 customers are basically 3,000 custodians who are holding their assets. So I think that's a pretty good basis that institutions are moving into the space, right? So not just crypto native firms, but asset managers, hedge funds, pension funds, these types of institutions. And really kind of the thesis that we have at Fireblocks is like the wallet is your entrance and your kind of control layer into these types of assets, right? So if you're not owning the wallet yourself and you're essentially passing that to a third party, you can't really control governance, you can't control transaction integrity, you can't control policies that are basically implemented. So we see that kind of wallet infrastructure as the first step. And then the way that you access other types of assets, whether it's issuing your own, accessing DeFi, based on that stack as well. So I would say of the 6 trillion that's processed in Fireblocks, maybe only 2% is in DeFi at the moment. So I think we're very early. But as the market is growing, as protocols are being launched like Horizon and others, I think we're at the stage now where the flows come into the market.
It's a very interesting data point. So actually, let me follow up with a question. So, and the institutions that you are onboarding that are still mostly using like centralized solutions. If you can share, some of your lessons learned or what you are seeing, because you are probably the perfect lens on the institution side. So what is the main use cases that they are looking for?
So I think like from a DeFi perspective, there's probably 3 major use cases that we're seeing. So I would say the first one is around on-chain treasury, right? So you've got a lot of these crypto native firms who have large amounts of stable coins. They're looking to get some form of yield. I think the success of money market funds was a good example of driving that need there. So like a tokenization use case that has really good product market fit. We're also seeing institutions kind of stepping now into the space of lending those money market funds and also the stable coins they have on balance sheets. So I think that would be a number 1. Number 2 then is more around kind of the trading firms and pension funds that you would see. So they're essentially being using DeFi. So a lot of these large firms you see, Wintermute, B2C2, Cumberland, Galaxy, who've been operating in the space for a while, but they're the real users from an institutional perspective of DeFi that we see at the moment. And then I think the third one, which kind of harps back to the last panel that we saw, is really around on-chain financial markets. So we're seeing a lot of companies essentially stepping in and starting to issue now. And when we've got high quality yielding assets that can now be lent and also borrowed against, we're starting to see a lot more interesting use cases than just stable coins. So I would say they're kind of the 3 pieces when we talk about institutional DeFi that we're seeing, on top of all the banks, asset managers, issuers that are moving into the space that are going to provide other types of assets there on the institutional side.
And are they interested in tokenization, the leaders that you mentioned, like banks and?
Yeah, so like, I think a common misconception, or maybe something that isn't very well known about Fireblocks, is we work with about 100 banks globally. So that's everything from GSIBs like BNY Mellon through to like the likes of Revolut and Nubank and other types of crypto native players. And they're essentially focusing on custody as the initial use case to kind of build out the infrastructure. But then they're looking at things like, what are the assets that we have that make sense to tokenize from a collateral efficiency basis, from posting a margin basis. And really tokenization is the second use case we're seeing people step into. So we're seeing stablecoins being interesting. We're seeing money market funds and bonds. I think we're going to start to see more things which are maybe more specific to the European context, like structured products, for example. So absolutely, tokenization is a use case that a lot of these big firms are interested in.
On this perspective, Jason, is actually very valuable your point of view, because you see like everything that is happening on the centralized like space with OKX, and now you are offering like a decentralized product for like probably matching the needs that you're not like matching with the OKX centralized infrastructure. So, but you are entering the space where there are a lot of networks, a lot of like stable coins, a lot of other solutions. So I would be curious, like, you have already the network of institutions. So what's the value proposition and the services that you are offering to distinguish yourself with X layers compared to the other networks?
Yeah. So if you think about where we sit, where we have been offering centralized services to, again, institutions and retail, one thing that we're excited to talk about today is obviously Aave launching on X Layer today. That went live a few hours ago. So that's very exciting, and thank you. And that really ties into taking what we have, which is users, which is liquidity, and then helping these users bridge into and start exploring what DeFi could be in a way that they, like you said, like a way that's, you got to meet the user where they are today, and bridging it in a way where they can access all those benefits, but at the same time have a familiar experience and familiar understanding of all the risk and all that. Having us as that sort of intermediary to start, I think, is where this is a great point to be. We're calling it CDeFi, not the most original name, but really just, again, taking both parts together and bringing it together. And XLayer sits right at the middle of that. We're already doing that with our pay product, but now with the launch of Aave, borrowing, lending, we're going to be integrating that into our broader exchange product. So yeah, it's a very exciting time.
And what's your approach with stablecoins?
That's a very long-winded question. Can you be more specific? Obviously, we support a lot with that.
Do you are you enabling some specific bridging between other chains, like fasting bridging, or some what's the value proposition of the stablecoin? Because in my opinion, one of the difficulty that the chain are having today is to attract the stablecoins, because the stablecoins are on Ethereum, and you need to give the motivation for the users to move the stablecoins there. How do you think to attract the stablecoins into your chain?
So I mentioned payments earlier on XLayer specifically. I'm only talking about XLayer here. We built our OKX Pay product on top of XLayer, taking advantage of the speed and the low fees. And that we've seen tremendous growth on that space already. And that's really OKX users making payments to merchants, making payments to each other. And so that's one way where we're building and taking the benefits of XLayer directly into a product that users are quite familiar with and have experienced. And another thing is obviously, I think, again, want to double click on this, is obviously the launch of Aave on XLayer is going to be a big moment whereby there will be yield opportunities, there'll be borrowing opportunities, lending opportunities. And again, we're going to be directing and making that accessible to the wider OKX audience. So I think there's chicken and egg network effects at play here, but I think those are the core sort of foundational pieces for stablecoins. And then you talked about RWAs too. You might have seen our announcement with Hamilton Lane, a large asset manager, that they're going to be issuing hybrid RWA assets onto XLayer 2, again, to provide for opportunities for users to get yield and gain access to additional types of financial products.
Well, for you, Reid, actually, I find very interesting what you are building in the space, and I see that is one of the most probably attractive real-world asset in the space. And because you are matching what institutional are looking for, that are liquidity and this kind of opportunities that were reserved to institutional investors, you are kind of making on chain available to everyone, and so matching the DeFi users with the institutions. So the first question that I was having is where do you find more difficulty, to scale on the institution side or to scale on the DeFi user side? Because you need to explain, an yield-bearing asset that is not so, the standard for the DeFi users.
Yeah, so I think one of the themes that we're all talking about, right, is access, and there's different types of institutions. You just had a bank here, right? There's smaller community banks. And for us, it's unlocking access for products that some institutions don't even have access to. So we're mostly well known for HELOCs, and so Democratized Prime is sort of our platform for democratizing access for HELOCs. So for some institutions in TradFi, you would use a warehouse, right? So you would post those loans to Goldman or Jefferies, and they'll advance against that. But if you're a smaller community bank or even a lot of funds, that financing opportunity, because of the collateral, which is really high quality, isn't available to you. So it's not just, okay, we're unlocking like a private credit fund, or we're unlocking more QP products for retail. There's also institutions in TradFi that just don't have access to that. So going back to this idea around serving customers the way that they're used to or want to interact, there's plenty of institutions that want a DeFi access to a permissionless token to that lending opportunity. And we see them, we see plenty of institutions on Solana doing that, for instance. And then there's plenty of credit funds that are actually onboarded to our Web 2 version, which again looks like a Web 2 login, but it's MPC. So I think it's as we look for other types of asset classes that are somehow locked behind a bank balance sheet, or are locked just from a regulatory perspective for even institutions, that'll start to trickle down across the spectrum.
Okay, so I want to like slightly switch the topic on how you, what kind of requests actually you receive from institutions when you're like having discussions with them and you start to explain DeFi, because, we're seeing, for example, at Aave, you need to do a lot of educations with institutions. So it's like, how do you explain, or maybe what are your main concerns actually about DeFi? So maybe you can start, Reid.
So concerns from like a risk perspective?
Yeah, from a risk perspective, yes.
So I actually don't think it. I don't think it is risk. I think it's liquidity, candidly, and certain types of assets. How can you provide liquidity for them if they're not fungible, or the amount you wanted to liquidate was not the whole asset, right? It requires a lot of dead capital to sit in a liquidity pool that isn't earning, to demonstrate that yes, there's liquidity there. So that's been one of, I think, the more challenging pieces with talking with other institutions, or where again, these products are accessible across that whole spectrum, is, well, is there liquidity for this, right? And I think the first iteration of kind of RWAs that came on chain, we're seeing a lot of different people try different things for how can an interval fund get liquidity on chain. And for us, we've kind of taken a step back and said, okay, well, the issue is that these individual loans are not fungible. And so if it's a HELOC, and the four of us have one, it may have the all same tight credit box, but if I default on mine, it doesn't impact the price of U3, right? So going back, and because of the scale and the TVL of these loans, we introduced a couple weeks ago something called Figure Forge. And the idea here is that we can pool together similar loans or credit assets. They're similar, and with our own kind of liquidity provisioning and access to securitization vehicles, we're actually able to provide liquidity across non-fungible but similar assets. And we'll start doing that with a ton of different other credit products, whether we launch consumer auto loans, SMB, trade receivables, inventory finance. So I think liquidity is really the biggest question we get from institutions, and also from users on chain.
Yeah, fully agree. So like when we're having, unfortunately, a part of my job is speaking with these risk committees and preparing customers for going through them. So we see three main risks. So I'd completely back up the liquidity one. Like the question, can I exit in stress, is the one where if you can't answer that question, then a firm is not going to move in the space. So that's pretty easy to start off with. I think the second one is around kind of the regulatory risk. So we have certain activities that are permissible under certain regulations, activities permissible under MiCA. But is it permissible to use the protocol? Is the protocol regulated? This is a question which comes up a lot. So there's a lot of education required on that particular topic, right? And that's a tough one to go through. And then the one that we're obviously majorly focused on as a cyber company is kind of technology risk, right? And technology risk we see is kind of two guises, right? So you've got the on-chain technology risk. So are you connecting to a smart contract which is fraudulent? Is it going to drain your funds? So we basically build, protocols. For example, we have a DeFi threat module, which essentially identifies the smart contract, who else is using it across the Fireblocks customer base. So that's kind of an easy piece. And then on the other technology side, it's kind of the operational risk around how you manage your keys, how you manage your policies, which is obviously what you'd be looking for your infrastructure provider to do. So they'd be the three areas: regulatory risk, liquidity risk, and obviously the kind of technology risk, which is on-chain and also in your own setup.
not too much to add. I think I echo those. I think maybe one thing might be, I think, as regulated institutions, obviously institutions are familiar with those types of conversations, what we just discussed. But then there's the potential benefits of on-chain and DeFi that actually lower the risk for some of these committees, right? We talk about the transparency that's afforded by on-chain protocols. We lean into our proof of reserves that we've been doing for 3+ years now, allowing our regulators and our clients just more comfort around how assets are being stored and managed. And then lastly, if they this is not purely DeFi, but for institutional customers that have either mandates or issues where they don't feel comfortable custodying with us, we work with third-party custodians like Standard Chartered Bank, for example, whereby you could park your assets with them and still trade with us. Like that's another way to sort of mitigate some of these risk concerns.
And on the let's look for a second on the chain perspective, because you have maybe Fireblocks an agnostic approach. You have like connection with provenance because you have to do like a lot of checks on the users. You are running your X layer, obviously. So institutions are using a lot of like services like Fireblocks or Bitco or Custodian or MPC, and they are interested in liquidity. They are interested in assets. And initially, like a few years ago, everything that was like outside of Ethereum was like, meh, I don't know, I need to check, But now seems that, there is more, let's say, flexibility from institutions to go and follow the assets and the liquidity, as you were saying above. So it could be interesting to understand your point of view on this, like, the chain still matters? Like, are they doing the final choose on the chain, or they are becoming more agnostic? Maybe, Jason, you can start. You are a bit biased here, but...
Well, actually, I think that's an interesting one because we service so many different users, and liquidity does not sit on one chain or anything like that. I'd argue we're probably one of the earliest that pushed for a multi-chain approach. Our wallet was launched with fully multi-chain, over 100 different networks supported today. We support our competitors' networks. We support, obviously, our own networks. And so I would say we're very, very much agnostic. But I think for X-Layer, I think there's a unique advantage whereby we can build products that are very specific and tailored to our user base. And that's where we hope that unique user experiences and product experiences come about. That's sort of the bias, and obviously working with you guys is a big part of that. But I think back to the core point, I think is obviously offering users choice and access means you don't necessarily get to pick which chain people prefer to go or where they want to go find these opportunities. So for us, that's offering as much as we can, while hoping to create moments and experiences that users value.
Yeah, so I mean, I think it matters what's the use case, right? So we don't believe that provenance as an omni-chain is going to solve everything, right? But it's core and fundamental to how we built our business, which operates on provenance. That said, though, we're moving to Ethereum. We've launched on Solana. Like, we think there is a reason if there's a use case if there's a use case for adding composability, the chain does matter. And there's also a user experience, right? Certain chains have real quick finality. Certain chains are really expensive at certain times. Like, it's whatever the user experience that would demand the asset to be there, then it probably should be there.
You are helping like institutions also to choose the chains, right? So if you need to issue new assets or yield-bearing assets or whatever assets for institutions, are you mostly be driven by the liquidity? So if the liquidity will be on Solana, you will issue on Solana, or you will issue on Ethereum, or?
No, so all of the assets that we issue are tokenized on provenance. And that is just fundamental to the way that we've built our business and having a purpose-built chain for that origination. So we won't move that system to another platform. But we think that, again, wherever there is stablecoin liquidity and there's a user base that views composable assets have a place there, then we have no problem sort of expanding. That said, though, like we're not going to expand to 50 chains, right? So I think if there's a demonstrable and a defensible growth path for liquidity or some new platform's feature that benefits from the assets that we do originate, then we would certainly love to explore it.
John?
Yeah, and then I guess from our perspective, we support 150 chains, but I think the reality is, there's like 10 or 15 which are being used on a max basis. That's the John opinion, not the Fireblocks opinion, in that sense. So I think there's nuance in the question. It doesn't matter for the issuer or the institution. So the issuer, it does matter. So I think being able to be multi-chain from an issuance perspective to meet liquidity is something that does matter. So for our customers that are issuing, we've integrated Layer 0 and Chainlink, so they have kind of flexibility around that interoperability of issuance. But I think if it's an institution which is kind of seeking capital or looking to lend, they're going to go where the liquidity is. So I think that's the reality. And then I think from a chain basis, we're probably going to go to kind of a split into two different ethoses, I would say. So number one is kind of the more generalist-based chains, so mostly the EVM-based chains, Solana, and then we're going to have the more kind of use case-specific chains. We're going to have Tempo, Arc, these types of chains which are focused on specific use cases. And like the goal from us, from an infrastructure perspective, is to support all of them, right? Because our customers need to access depending on the use case, and it's kind of multifaceted. So I think that's kind of the direction of travel that we're seeing.
So we are almost there. I will just ask you a last question, one sentence each one. Like, what needs to happen to unlock, 1 trillion DeFi institutional capital? We are at DeFi Day event, so one sentence to everyone. What will need to happen, like in the next 24 months, to unlock 1 trillion of liquidity from institutional capital? You can start, Jason. One sentence.
I think we're well on our way. I think we're doing great
sentence.
things. Yeah, I'm sorry. I think we're progressing nicely, actually.
I mean, I think for credit assets in particular, I think we had this weird like dynamic around like crypto bros woke up and decided they wanted to be asset managers, and then you had real TradFi asset managers who maybe didn't take the most like crypto native approach in building that product. So I think really what needs to happen is we need asset managers who are first and foremost building products for crypto, not necessarily just taking something that existed in TradFi and making it exist on chain, but a more genuine natively built product.
I think a more robust on-chain compliance infrastructure, I think. So being able to port your identity across different apps, being able to not have to kind of go through the KYC process. Like we are very early, Fireblocks and Aave on the Aave Arc solution, the institutional DeFi solution, which was obviously on a whitelisting basis. The identity infrastructure has progressed so much in the last 4 years. So I think if we can kind of get a standard which is implemented across the industry where you can issue and go into assets across different protocols, I think that's where we see the TVL starting to jump up quite massively.
Okay, thank you everyone. So we had like 3 different point of views, and very excited to see how this institutional world will evolve during the next months. Thank you for participating.
Thank you.